Hello and welcome to The Chart Show. I'm Victoria Scholar and this week's three charts are Twitter, the Hang Seng and Taylor Wimpey. Twitter has accepted Elon Musk's offer to acquire the company for $54.2 a share, valuing Twitter at approximately $44 billion. On completion of the deal, Twitter will delist from the public markets, becoming a privately held company instead. Initially, Twitter was opposed to relinquishing ownership to the Tesla chief amid a difference in opinion on the role of the social media platform. However, when no counter-offer materialised, Twitter made a U-turn and decided to engage in talks with Musk instead. Given the recent sharp sell-off in the US tech sector, with other stocks like Netflix and Meta nursing heavy losses, the M&A speculation has kept Twitter's stock well supported. So, the board decided to take the generous offer instead of risking the bearish fate of some of its rivals. There are big questions ahead about what Musk's leadership will mean for the company. There's the possibility that its headquarters could move to Austin, headcount could face cuts, and there's likely to be an ideological shift in terms of the company's focus away from content moderation and towards free speech instead. Let's take a look now at the chart of Twitter because the stock price was at 51.63 before trading was halted pending the news announcement on Monday. Although this offer represents a premium of more than 30% to Twitter's share price before Musk's stake was announced earlier this month, it's still sharply below the peak from February of last year. On the chart, we can see that from the pandemic low in 2020 to the peak in 2021, the stock managed to stage gains of more than 300%. However, unfortunately, after the end of Trump's presidency, Twitter's stock price lost its shine, shedding most of those gains from around $80 a share to just $30. Once the Musk stake was announced, the stock gapped sharply higher, and now shares are trading close to the offer price. However, shares won't be publicly traded for much longer if the deal goes through, with shareholders receiving cash in exchange for their shares on completion of the deal. Chinese equities have been under pressure with the Hang Seng and the Shenzhen composite nursing heavy losses on Monday, while the yuan hit a one-year low after Beijing reported a jump in COVID cases over the weekend, while mainland China grapples with its worst outbreak since the start of the pandemic in early 2020. Meanwhile, China's economic hub Shanghai reported growth of 3.1% in the first quarter, slowing sharply year on year as the city remains under prolonged lockdowns. Now, Chinese stock markets have been hit both by negative momentum carrying forward from last week's slump on Wall Street, as well as fears about Beijing's zero-tolerance policy to fresh COVID outbreaks, which comes at the expense of China's already fragile economic growth outlook. Growth looks set to be particularly weak in April this year as China's main engine of growth, its property market, contracts, with highly leveraged real estate deals a thing of the past. The People's Bank of China, its central bank, helped to relieve investor nervousness on Tuesday by pledging to cut banks' foreign exchange reserve requirements and provide liquidity to support its financial markets. Let's take a look now at the chart of the Hang Seng because since the peak in early 2021, we can see that it's been trading in a descending trend line with lower lows and lower highs. There was a key historical zone of support and weakness, which is around 22,500, and we saw the index decisively break below that level. It's also broken below the next major round number support at 20,000, potentially suggesting there could be further weakness ahead. It's trading at lows not seen since 2016, and if it pushes further south, then it could hit the 2016 trough, which was when we saw the last serious bout of stock market turbulence in China. Keep a watch on 20,000 as the next major resistance level, and if the index remains below that level, then that could indicate further bearishness to come. Taylor Wimpey says it's on track to achieve its guidance set out in March with resilient demand for new housing despite the uncertainty. The house builder said house price growth is reflecting the strength of the market and offsets labour and material cost inflation. Despite a booming housing market, shares in Taylor Wimpey have shed around a third of their value over the last 12 months. The house builder has been dealing with cost inflation, millions of pounds set aside for cladding provisions, rising rates, as well as the cost of living crisis. However, this week's upbeat report has provided some confidence to investors, initially pushing the stock to the top of the FTSE 100 on Tuesday, suggesting that it's managing to navigate the challenging backdrop. Taking a look at the chart of Taylor Wimpey, we can see that after initially attempting to recover from the COVID-driven sell-off at the start of 2020, the stock has been faced with lower highs and a descending trendline for around a year, with losses accelerating this year, pushing the stock down towards support at around 122, lows not seen since November of 2020, when the first successful vaccine was announced, spurring sharp gains across equities. Below that, the next major support level to watch is at the psychological 100 mark, which was around the pandemic low, with a break below potentially paving the way for further declines.